This is the coverage for week 2, the qualitative characteristic of useful accounting information and other accounting assumptions and concepts. So once again, please have before you your textbook, which is covered in the last chapter in your textbook, so that it can act as your reference as we go along with the slides. We begin our video lecture with what is qualitative characteristic. Okay, so qualitative characteristics are what make the accounting information useful. So in order for the accounting information to be useful, they must possess certain characteristics that enable the user to make decision making. According to Malaysian Accounting Standard Board, for the information to be useful, they must be, first of all, they must be relevant, they must be faithfully represented, the information must be comparable, the information must be verifiable, timely, and understandable. So these quality accounting information will enable the users to make informed and timely decisions. Furthermore, the business decision taken based on less quality information may not give good decision and may also harm the business. So these are the 6 qualitative characteristics that you must know, meaning that you must know what it represents. Okay, the first characteristic is the relevant. So the accounting information is relevant if it can influence the user's decision making. Okay, so if the information that the user receive from the financial information influence their decision making, whether to invest or not, then the information is deemed to be relevant. If it cannot influence the user decision making, then the accounting information is irrelevant. Alright, the second characteristic is faithful representation. The word faithful representation means it must be free from error or mistakes, and the information must be neutral and complete. Okay, so we need to check and double check the information published to the users, and it must be free from errors or mistakes. The third characteristic is comparability. User must be able to compare the performance or the financial position of the business with their last year's performance or with other competitor. Okay, so if the information is comparable, meaning that it has the same basis of argument, same basis of assumption that make it comparable, then the information is deemed to be quality. The fourth one is the verifiability. So the information given to the user must be able to be verified. It must be proof with the presentation of evidence. Okay, if you say that you have car worth a certain amount of money, the user must be able to verify the information that the company has that car by looking at the deed of ownership or the outflow of the cash. It must be verifiable. Mesti ada bukti lah. And the fifth one is timeliness. Okay, the information can be relevant, it can be faithfully represented, it can be comparable, it can be verifiable, but it is not a quality information if it is reported in untimely manner. Maksudnya, it means that the information is received by the user late, meaning that it's no longer viable for decision making. Okay, therefore the information must be reported in timely manner so that prompt and good decision and actions can be undertaken. Otherwise, it may lose its relevance and no longer useful. Right, and the sixth one is understandability. Accounting information presented in the manner that is understandable to the users. Okay, when user read the accounting information, they understand what the report is trying to say, meaning that the user themselves must have at least the basic knowledge of business operations and accounting knowledge. Okay, the next one is accounting concepts and conventions. So accounting concepts and convention are what guides the accountant to record their business transactions. Without accounting concept and convention, the accountant do not have the guideline on how to record the business transaction on daily basis. Okay, so he must follow the accounting concepts and convention to ensure the transactions are recorded in an accepted manner. An accounting base is to ensure the value of the transaction recorded are measured in an accurate way. Alright, for example, that transactions are recorded using the accrual basis. So whenever you want to value something, you must follow the accounting base. Accounting policy refers to the method used to value the transaction. Accounting base is how to value. Accounting policy refers which method used to value the transaction. So we're going to see the policy when we go to the depreciation methods. So you have 5 accounting concepts and conventions that you need to know. The first one is business entity or separate business entity concept. So this concept assumes that a business activities are separated distinctively from its owner's activities. Okay, so when there's a cash inflow or cash outflow, we need to identify whether this transaction belongs to the business or belong to the owners. So we only record the transaction that are applicable to the business activities. So separate the two items together. The second concept is going concern concept. So this concept assumes that a business is going concern, meaning that it will continue to operate in the foreseeable future using its asset to carry its operation and not offering the assets for sales. Meaning that when you set up a business, you aim to operate your business forever and ever, for a foreseeable future. And if you aim to open your business only for 1 month or only for 1 year, then the concept of going concern is violated. Okay, therefore the method of you valuing your asset will not be the same as we did if we assume the going concern concept. Okay, so whenever you want to record the transaction, you must assume that the business transaction have a long life, then it will last long enough to fulfill the objective and their financial commitment. Therefore, when you value your asset, you will value them using the historical cost convention. Okay, what is historical cost convention? We're going to talk about that later. Okay, the third one is monetary or money measurement concept. So we assume that all accounting transactions can be recorded using ringgit Malaysia. All of them. It means that the money is the common denominator and can provide as an appropriate basis for accounting measurement analysis. Okay, everything can be recorded using the ringgit Malaysia or common monetary denominator. Okay, the fourth one is accrual-based accounting. So this assumption assumes that expenses for the accounting records must be recorded irrespective whether they have been paid or not. So we do not record an expense when the cash has been paid. We record them when they are incurred. Okay, so if you have already purchased a stock, irrespective whether you have paid the stock or not, you already have purchased the stock. So you record on the day you purchase, not on the day they are paid. Okay, so it means expenses are recorded when they are incurred and not when they are paid. Okay, similarly, revenue are brought into the account of the current accounting period, whether the money has been received or not. Example, like you have generate sales, you have sold off your stock to your customers. It doesn't matter whether your customer has paid for the item that they have bought. The important if the sale has already been incurred. Okay, so if they pay for next month, if they pay for next year, you record them to be as assets. But the sale must be recorded in the period in which they have earned, not when they have been received. Okay. And lastly is historical cost concept. So remember when we talk about the going concern concept, where if the company assumed to be going concern, we record the asset using the historical cost concept. So this principle states that assets and liabilities should be based on the actual price transacted, not based on its market value in the statements of financial position. So it means that if I bought the car for 60,000, I'm going to maintain the cost of the car for the coming years in the financial statements. So next year I also record the 60,000. The next 3 years I also recorded at 60,000 for the same car. 4th year 60,000, 5th year 60,000. We maintain it based on the actual price transacted. Okay, but to reflect to the decrease in the value, because we have used the car, of course the value will be reduced. We're going to provide depreciation for that car. Okay, we're going to learn about that later on. Okay, historical cost principle is used because it provides important cash flow information as it represents the actual amount paid for the assets. And this concept is highly objective, meaning that it's 60,000, it is 60,000. It cannot be disputed, and it can be verified using the deed ownership or the cash flow receipts or invoice. So that's the end of our second week of topic. So you can, for further reading, you can refer to your textbook. For further understanding, you can look at your past years and do the tutorial stated in the past years. So thank you for your time and your patience and your attention. I'll see you next week.